You know what I find fascinating, Charlie? I meet brilliant people all the time: doctors, engineers, professors, people who can solve complex problems in their sleep. Yet many of them reach 55 years old and have almost nothing saved. Meanwhile, there's a plumber down the street from me who never went to college, and he retired comfortably at 62 with a paid off house and a portfolio that'll support him for life. What's going on there?
That's not mysterious at all, Warren. Intelligence and wealth building are two completely different skill sets. The plumber understood something fundamental that the doctor didn't. You don't need to be smart to get rich. You need to avoid being stupid. And here's the paradox: highly intelligent people are often spectacularly stupid when it comes to money. They make the same catastrophic mistakes over and over, but they make them with sophisticated reasoning. They can explain in elaborate detail why their terrible decisions are actually brilliant. The plumber, he just followed three simple rules: spend less than you earn, don't try to get rich quick, and let compound interest do the heavy lifting. No PhD required.
Let me tell you about a lawyer I knew. Absolutely brilliant mind. Could memorize case law like you wouldn't believe. Argued cases with precision that would make you think you were watching a chess grandmaster. But he was always broke. Always. And the reason was simple. He thought his intelligence entitled him to a certain lifestyle. He drove a brand new luxury car every 3 years, lived in a house that screamed successful attorney, sent his kids to the most expensive private schools. His entire financial life was structured around signaling to other people that he had made it. The irony? He hadn't made it at all. He was on a treadmill, running faster and faster just to maintain an image.
That's the first trap right there: confusing income with wealth. Smart people often have high incomes, which becomes their greatest liability. They think, I make $200,000 a year, so I'm doing fine. But wealth isn't what you make, it's what you keep. I've seen people earning 70,000 build more actual wealth than people earning 300,000, because the person earning 70 had the discipline to save 40% of it, while the high earner was spending 110% of their income, making up the difference with debt. The high earner feels rich, lives rich, but is actually poor. They're one job loss away from catastrophe.
And here's what makes it worse: the smarter you are, the better you are at rationalizing these decisions. I remember this doctor who bought a $70,000 car, and he explained it to me like he was publishing a paper in a medical journal. He said, Warren, I've calculated that my time is worth $500 an hour based on what I bill. This car has superior reliability ratings, which means fewer trips to the mechanic. It has better safety features, which reduces my insurance premiums. And the comfort features mean I arrive at work less fatigued, which improves my performance. It was beautifully reasoned. It was also completely wrong. What he was really doing was buying social status and then hiring his intelligence to justify it after the fact.
The intelligent mind is a wonderful servant, but a terrible master, especially when it comes to money. Here's what happens: smart people are used to being the smartest person in the room. They've been rewarded their entire lives for being clever. So when it comes to investing, they think, I'm smart, therefore I should be able to beat the market. I should be able to find the angles nobody else sees. This is catastrophically wrong thinking. The market is filled with thousands of extremely intelligent people who've dedicated their entire careers to finding mispriced assets. You're not going to outsmart them by reading a few books and thinking hard. But the smart person can't accept this. Their ego won't allow it.
I've watched this play out 1,000 times. Smart person discovers the stock market, gets excited, starts reading everything they can find. They learn about options, derivatives, technical analysis, all these complex instruments, and they think, aha, this is where my intelligence gives me an edge. So they start trading, and at first maybe they get lucky. They make some winning trades and they think, see, I knew I could figure this out. But what they're actually doing is confusing a bull market with genius. Then the market turns, and they lose everything. And because they're smart, they don't just lose, they lose spectacularly, using leverage and complex instruments that amplify their losses.
The successful plumber we mentioned earlier, he bought an index fund 30 years ago and never looked at it. He didn't try to be clever. He didn't try to time the market. He didn't even understand half of what he owned. He just kept putting money in every month like clockwork. And that boring, unintelligent strategy beat 95% of actively managed funds over that time period. Intelligence is actually a handicap here because it prevents you from doing the simple, boring things that actually work. Smart people need complexity. They need to feel like they're doing something sophisticated. But wealth building isn't sophisticated. It's mind-numbingly simple, which is why smart people are so bad at it.
There's another pattern I've noticed with intelligent people. They optimize for the wrong things. Engineers are particularly bad at this. They'll spend hours researching to save $50 on a purchase, comparing 17 different options, reading hundreds of reviews. They feel productive because they're exercising their analytical abilities. But then they completely ignore the big decisions. They don't negotiate their salary because negotiation feels uncomfortable, and they can't optimize it with a spreadsheet. They don't think carefully about what city they live in, even though geography can mean a $100,000 difference in lifetime earnings and cost of living. They focus their intelligence on things that don't matter and ignore the things that do.
That's because small decisions feel manageable and controllable. You can research toasters. You can make a spreadsheet comparing their features and prices. It gives you the illusion of being smart and in control. But the big decisions, where to live, who to marry, what career to pursue, whether to start a business, these are messy and uncertain. You can't optimize them with pure analysis. So smart people avoid them or make them impulsively, and then they wonder why their lives didn't turn out the way they expected. The truth is, 5 or 6 major decisions will determine the entire trajectory of your financial life. And all your clever optimization of small decisions won't matter if you get those big ones wrong.
Let's talk about lifestyle inflation, because this is where I see brilliant people destroy themselves. Here's the pattern. Someone finishes medical school or law school. They're in their late 20s or early 30s, and suddenly they're making real money for the first time in their lives. After years of being a broke student, they feel like they've earned the right to spend. So they upgrade everything all at once. Nicer apartment, new car, better clothes, expensive restaurants. And here's the killer. They structure their entire life around that new spending level. Within 6 months, the higher spending doesn't even feel like luxury anymore. It just feels normal. It's their new baseline.
And once you ratchet up your lifestyle, it's almost impossible to ratchet it back down without feeling like you're suffering. This is the hedonic treadmill, and intelligent people are particularly vulnerable to it because they're constantly comparing themselves to other successful people. The doctor compares himself to other doctors. The lawyer compares herself to other lawyers. And in those circles, there's an arms race of consumption. Nobody wants to be the one driving the oldest car or living in the smallest house. So they keep spending more, even as their income rises, and they never actually build wealth. They're on a treadmill that goes faster and faster, but they never get anywhere.
I'll give you a specific example of how this plays out. I knew a couple, both engineers at a tech company, combined income of about $400,000 a year. Absolutely brilliant people, could talk for hours about algorithms and system design. But they were living paycheck to paycheck. How? Well, they lived in an expensive coastal city because that's where the tech jobs were. 250,000 went to taxes and expenses right off the top. They had a mortgage on $1 million house, monthly payment of about 5,000. 2 car payments because they both needed reliable transportation. Private school for 2 kids, 30,000 a year. Saving for college in 529 plans, maxing those out. They felt like they were being responsible. They were saving for college, but they weren't saving anything for themselves. After all the bills, there was nothing left.
See, they made the classic mistake of optimizing for respectability instead of for wealth. Everything they spent money on was defensible. Good schools for the kids, who could argue with that? A nice house in a safe neighborhood. That's just being a responsible parent. Reliable cars. Of course, you can't drive a junker when you're a professional. But the cumulative effect of all these individually rational decisions was financial fragility. They had optimized their lives for looking successful rather than being secure. And the intelligence that should have been their advantage actually made things worse, because they could rationalize every single one of these decisions with perfect logic.
Now compare that to what someone who actually understands wealth building would do. They might take one of those $400,000 jobs, but they'd live like they were making $80,000. They'd rent a modest place or buy a house well below what the bank would approve them for. They'd drive cars that were 5 or 6 years old, but well maintained. They'd send their kids to good public schools or find creative alternatives. And they'd save everything else. 250, maybe $300,000 a year. Do that for 10 years, and you have $3 million invested. With compound growth, that becomes 8 or 10 million by the time you're 60. At that point, you have real wealth. You have freedom. You can take risks, pursue interesting projects, retire early if you want. But the engineer couple, they'll work until they're 70 and wonder where all the money went.
And here's the brutal truth that smart people don't want to hear. If you can't build wealth on a $400,000 income, you won't build it on any income. The problem isn't that you don't make enough. The problem is that you lack discipline. People always think the solution is more income. If I just get this promotion, if I just switch to this higher paying job, then I'll start saving. But what actually happens? Lifestyle inflation absorbs the additional income. You make more, you spend more, and you're right back where you started. The only difference is that now you're trapped in an even more expensive lifestyle.
There's a reason I've lived in the same house for decades, and it's not because I'm cheap, though people certainly call me that. It's because I understood early on that every dollar you spend is a dollar that can't compound. A dollar spent today is not just $1. It's all the future growth that dollar would have generated. If you're young and you spend a dollar, you're really spending $10 or $20 of future wealth. Smart people understand compound interest intellectually. They can explain the math perfectly, but they don't internalize it. They don't feel it in their bones. So they make financial decisions as if money today and money in 30 years are the same thing, when in reality, they're completely different.
Let me tell you about another trap that catches intelligent people: the complexity trap. Smart people love complexity because it makes them feel smart. So they get involved in complicated investment schemes, limited partnerships, private equity, hedge funds. Someone pitches them on some sophisticated strategy that most people don't understand, and they think, haha, this is where my intelligence gives me an edge. But here's the reality: complexity is usually not your friend. It's usually a way for someone to extract fees from you while making you feel clever. The more complicated the investment, the harder it is to understand where your returns are actually coming from and what risks you're taking.
I've seen this with real estate syndications particularly. Smart person gets invited to invest in some commercial real estate deal. The sponsors show them a beautiful presentation with projected returns of 15, 18% annually. There are tax advantages, depreciation schedules, complex financing structures. The smart person thinks, this is sophisticated. This is how wealthy people invest. So they write a check. What they don't realize is that the projected returns assume everything goes perfectly. The sponsors are taking hefty fees regardless of performance, and they just locked up their capital for 7 to 10 years in an illiquid investment. Meanwhile, they could have put that money in a boring index fund with complete liquidity and probably done just as well or better after fees.
The irony is that the truly sophisticated investors, the ones who actually build generational wealth, keep things remarkably simple. They focus on a few core principles: buy quality assets at reasonable prices, reinvest the returns, be patient, and avoid catastrophic mistakes. That's it. There's no secret sauce. There's no complex algorithm. The sophistication is in the discipline, not in the complexity of the instruments. But this doesn't satisfy the intelligent person's need to feel clever, so they reject it and go looking for something more complicated.
Another costly mistake I see is the smart money fallacy. Intelligent people hear about venture capital, angel investing, private equity, and they think that's where the real wealth is created. I need to get in on that. So they take money they should be investing in a diversified portfolio and they put it into their friend's startup or some early stage investment they heard about at a dinner party. And yes, there are stories of people who made millions on early investments in successful companies. But for every one of those stories, there are hundreds of stories you don't hear about. People who lost everything betting on startups that failed. The mathematics of venture capital only work if you can invest in dozens or hundreds of companies, diversifying away the massive risk. When you're making 2 or 3 angel investments with money you can't afford to lose, you're not being smart. You're gambling.
And let's be clear about something: the people who actually make money in venture capital aren't the angel investors. They're the venture capitalists who get paid fees on the funds they manage, regardless of whether the investments succeed or fail. The angel investor takes all the risk and typically gets mediocre returns. The VC gets rich on management fees. But the smart person thinks they're the exception. They think their intelligence and their network give them an edge in picking winners. This is pure delusion. Even professional VCs who do this full time with teams of analysts have failure rates of 80 or 90%. What makes you think you'll do better investing part-time while working your day job?
Let me shift gears and talk about something that doesn't get discussed enough: the relationship between intelligence and risk tolerance. I've noticed that smart people often have very poor calibration when it comes to risk. They either massively overestimate their ability to handle risk, or they're so paralyzed by analysis that they take no risk at all. The overconfident smart person sees opportunities everywhere and doesn't properly consider what could go wrong. They start businesses without adequate capital, make leveraged investments, quit their jobs to pursue ventures before they've validated the market. They think their intelligence will allow them to navigate whatever challenges arise. And sometimes that works, but often it doesn't, and they lose years of their lives and all their savings.
On the flip side, you have the smart person who's so aware of all the ways things could go wrong that they're completely paralyzed. They've read about every financial crisis, every market crash, every economic disaster. They can explain in detail all the risks of any investment you propose. So they keep all their money in cash or government bonds, earning essentially nothing, while inflation quietly erodes their purchasing power year after year. They think they're being prudent, but what they're actually doing is guaranteeing a mediocre outcome. They've optimized for avoiding losses rather than building wealth, and there's a huge difference between those two objectives.
The rational approach, and this is something that takes emotional maturity, not just intelligence, is to take calibrated risks. You need to take enough risk to earn real returns, but not so much that a single bad outcome destroys you. This means diversification, which smart people often resist because it feels like admitting you don't know which investment will do best. It means accepting that you'll earn market returns most of the time, which feels boring and unimpressive. But boring and unimpressive, compounded over 30 years, makes you wealthy. Exciting and clever, compounded over 30 years, usually makes you broke.
Here's a specific scenario that plays out constantly. Smart person graduates from college, lands a good job, starts making $60,000 or $70,000. They have student loans, so they focus on paying those off aggressively. Meanwhile, their employer offers a 401k with a 4 or 5% match. The smart person thinks, well, I'm paying 6% interest on my loans, but the market might only return 7 or 8%, so I should focus on the guaranteed return of paying off debt. Sounds logical, right? But they're ignoring free money. The employer match is an immediate 100% return. You put in 4,000, your employer adds 4,000, you instantly have 8,000. There is no investment in the world that will give you a guaranteed 100% return. Yet smart people skip this opportunity every single day because they're being logical about interest rates.
That's a perfect example of optimizing the wrong thing. They're making a mathematically sound decision. Yes, paying off 6% debt is good, but they're ignoring the context and the opportunity cost. The right answer is to contribute enough to get the full employer match first, then tackle high interest debt, then increase retirement contributions. But this requires understanding that personal finance isn't just mathematics. It's mathematics plus human psychology, plus opportunity cost, plus time value of money. Smart people want to reduce everything to a single calculation, and life doesn't work that way.
Let's talk about another wealth destroyer, the prestigious career trap. Smart people are heavily socialized to pursue prestigious careers: doctor, lawyer, investment banker, consultant. These careers signal status. They impress parents and peers, and they pay well. So the smart person invests years of their life and often hundreds of thousands of dollars in education to enter these fields. And then they discover something unfortunate. These prestigious careers often have terrible economics. Yes, doctors make good money, but they don't start earning until their 30s, after a decade of school and training, and they carry crushing debt loads. Lawyers at big firms make good money, but they work brutal hours, and the attrition rate is enormous.
Meanwhile, there are less prestigious paths that build wealth far more effectively. Starting a small business, not a venture backed startup, just a profitable small business. Learning a skilled trade and starting a contracting company. Getting into sales in an industry with high commissions. These paths don't carry the same prestige, so smart people ignore them, but they often have much better economics. You start earning sooner, you can scale your income faster, and you're not carrying huge debt. The plumber who starts their own plumbing company at 25 and builds a business with 5 or 6 employees by their mid 30s might easily be wealthier than the doctor who's still paying off loans at 35, even though the doctor has more status.
And here's what's really insidious about the prestige trap. Once you're in, it's very hard to get out. You've invested so much time and money and identity into being a doctor or a lawyer that switching careers feels like admitting failure. You're trapped by sunk costs. So you keep working in a field you might not even enjoy anymore, making decent money, but not building real wealth, because the alternative feels like throwing away everything you've invested. The person who chose a less prestigious path at 22 has much more freedom to pivot, to experiment, to take risks, because they haven't invested their entire identity in a particular credential.
I want to talk about something that might be uncomfortable for people to hear: the relationship between intelligence and financial self sabotage. I've seen a pattern where very smart people unconsciously sabotage their own financial success. Part of this is imposter syndrome. They don't feel like they deserve success, so they make decisions that ensure they won't achieve it. Part of it is a weird kind of reverse status signaling, where being indifferent to money is seen as more noble or intellectual than actually building wealth. Academics are particularly prone to this. There's almost a pride in being absent minded about finances, as if worrying about money is beneath someone focused on higher pursuits.
That's exactly right, and it's a form of self deception. They tell themselves that money doesn't matter, that they're focused on meaningful work rather than crass commercial success. But then they're constantly stressed about bills. They can't afford to take opportunities that come up. They're dependent on their job and their paycheck. The reality is that financial security gives you freedom to pursue meaningful work without constantly worrying about survival. The artist who has saved enough to cover 2 years of expenses can take risks in their art. The artist living paycheck to paycheck has to take whatever commercial work comes along. Money might not be the most important thing, but lack of money severely constrains everything else in your life.
There's also a pattern where intelligent people are too proud to learn from others who are less educated but more successful financially. The doctor won't take financial advice from their accountant or financial planner because they think, I'm smarter than this person. Why should I listen to them? But being smart in medicine or engineering or law doesn't make you smart about money. These are different domains. The plumber I mentioned earlier probably couldn't explain the Krebs cycle or calculate a p-value, but they understood something crucial about money that the doctor didn't. And the doctor's intelligence actually prevented them from learning because their ego got in the way.
This comes back to what I said at the beginning. The plumber understood that you don't need to be smart to build wealth. You just need to avoid being stupid. And the smartest way to avoid being stupid is to learn from people who've actually done what you're trying to do, regardless of whether they're, quote, as smart as you are. I'd rather take financial advice from a high school graduate who built a successful business and retired at 50 than from a PhD economist who's broke. Credentials don't spend, results spend.
Let's talk about something critical that trips up smart people: the difference between complicated and complex. Complicated means there are a lot of moving parts, but they're knowable and predictable. Building a car engine is complicated. Complex means there are emergent properties and feedback loops that make the system fundamentally unpredictable. The economy is complex. The stock market is complex. Human behavior is complex. Smart people are trained to solve complicated problems, break them down, analyze the parts, find the solution. So when they encounter complex systems, they try to treat them the same way. They think if they just gather enough data, build a sophisticated enough model, they can predict what will happen. And they can't. Nobody can consistently over time.
This is why you see incredibly intelligent people lose fortunes trying to time the market or predict economic trends. They build elaborate models. They study historical patterns. They convince themselves they've found an edge. And sometimes they're right. Variance ensures that even a bad strategy will work occasionally. But over the long run, they can't beat randomness. The complex system is smarter than they are. The humble approach is to acknowledge that you can't predict complex systems, so you don't try. You build a portfolio that will do okay in most scenarios. You rebalance mechanically, and you accept that you'll never capture the absolute maximum return because you're not trying to. You're trying to avoid the catastrophic losses that come from thinking you're smarter than the market.
Here's a specific example of complexity versus intelligence: asset allocation. A smart person might spend weeks researching the optimal allocation between stocks, bonds, real estate, commodities, international versus domestic, value versus growth. They'll read academic papers, they'll run historical simulations, they'll try to find the perfect mix that maximizes return for a given level of risk. And you know what? Their elaborate portfolio will probably underperform a simple 60-40 stock bond portfolio over the long run. Why? Because the complex portfolio has more opportunities for behavioral mistakes, higher fees, more rebalancing decisions where they're likely to let emotions drive their choices. The simple portfolio is boring, but boring is resilient. Boring survives contact with human nature.
And here's the thing about simplicity: it's not the same as being simplistic. A simple investment strategy can be sophisticated in its reasoning. The reason we advocate for index funds isn't because we think stock picking is impossible. Obviously, some people do it successfully. We've done it ourselves for decades. It's because for the vast majority of people, including very smart people, the costs and risks of active investing outweigh the potential benefits. Your time is better spent on your career, your business, your family, your health. The additional return you might capture from active investing, if you're skilled and disciplined, which most people aren't, doesn't justify the time and psychological energy you'll invest. That's a sophisticated calculation that leads to a simple strategy.
Now I want to address something that smart people really struggle with: accepting average. If you've been in the top percentiles your entire life academically, the idea of accepting average investment returns feels like failure. You think, I'm in the 99th percentile of intelligence. Why should I accept 50th percentile returns? But this is category confusion. Investment returns aren't a measure of intelligence, and trying to get above average returns is actually how smart people end up with below average results. They trade too much, they chase performance, they invest in complicated strategies with high fees. The person who accepts average returns and minimizes costs and taxes ends up in the top 20 or 30% of actual wealth accumulation because they avoided all the mistakes everyone else makes.
That's counterintuitive for smart people because they're used to being able to improve outcomes through effort and intelligence. If you're smart and you study harder for an exam, you get a better grade. If you're smart and you work harder at your job, you get better results. But investing doesn't work that way. More effort often leads to worse outcomes because you overtrade, you overthink, you let emotions drive your decisions. The optimal strategy for most people is to set up automatic investments, rebalance once or twice a year, and otherwise ignore your portfolio. But smart people can't stand to ignore something. They want to engage with it, optimize it, improve it, and that engagement destroys value.
Let's talk about taxes, because this is another area where smart people make expensive mistakes. They focus enormous energy on tax optimization, complicated strategies with trusts and entities and offshore accounts. Sometimes this makes sense if you're very wealthy, but for most people, the best tax strategy is simple: maximize contributions to tax-advantaged accounts, hold investments long-term to get favorable capital gains treatment, and don't let the tax tail wag the investment dog. I've seen people make terrible investment decisions because they were trying to avoid taxes. They hold on to a losing investment because they don't want to realize a loss. They sell a winning investment too early because they're worried about taxes. The tax consideration should be secondary to the fundamental investment decision.
And here's a simple truth that smart people need to hear. You're going to pay taxes if you build wealth. That's not a problem to solve. It's a sign that you're succeeding. Someone who's complaining about their tax bill is usually someone who's making money, which is much better than the alternative. Yes, you should be tax efficient. Yes, you should take advantage of legal strategies to minimize your tax burden. But spending enormous amounts of time and energy to save a few $1,000s in taxes is often a poor use of resources, especially if it distracts you from the activities that actually build wealth: growing your income, building your business, developing valuable skills.
Another issue I see with intelligent people is analysis paralysis. They want to make the perfect decision, so they research endlessly. Should I buy this house or rent? Should I take this job or that one? Should I invest in stocks or real estate or start a business? And while they're researching and analyzing, time passes. Opportunities disappear. The house they were analyzing gets bought by someone else. The job offer expires. They're so busy trying to optimize the decision that they never actually make a decision. And in many cases, making a reasonably good decision quickly is better than making a perfect decision slowly, because time has value.
This is especially true in investing. The person who starts investing early with a mediocre strategy will often end up wealthier than the person who waits until they've figured out the optimal strategy. Why? Because they captured more years of compound growth. Starting to invest at 25 with a simple strategy beats starting at 35 with a sophisticated strategy, even if the sophisticated strategy has slightly better returns. Time is your most valuable asset when you're young, and smart people often squander it in pursuit of perfection. Good enough, implemented consistently over a long period, beats perfect.
There's also the issue of what I call optimization theater. Smart people doing activities that feel like they're building wealth but actually aren't. Reading investment books, listening to podcasts about personal finance, researching different investment strategies, building elaborate spreadsheets to track their net worth. These activities feel productive. They engage the intellect, but they're not actually moving the needle. The things that actually build wealth are much more boring. Earning more money, spending less than you earn, investing the difference consistently, and waiting. That's it. Reading another book about investing doesn't build wealth. Putting more money into your investment account builds wealth.
And let me be clear, learning has value, especially early in your journey. If you know nothing about personal finance, yes, read some books, educate yourself. But there's a point of diminishing returns. Once you understand the basics, spend less than you earn, invest in diversified, low-cost index funds, avoid death except for productive assets like a house or business. Be patient. You probably know enough. The person who reads 50 books on investing doesn't have 50 times the knowledge of someone who read one good book. They probably have the same knowledge, plus a lot of confusion from contradictory advice. At some point, you need to stop learning and start doing.
Let me tell you about what actually matters if you want to build wealth, especially if you're starting from zero or from negative, which is where most smart people start because of student loans. First, you need to dramatically increase the gap between your income and your spending. This is the only way wealth gets built. There are two ways to do this: earn more or spend less. Smart people often focus exclusively on earning more, which makes sense. That's what their intelligence is good at. But they completely neglect the spending side. You need both. If you can increase your income by 50% while keeping your spending flat, that's huge. But if your spending rises in lockstep with your income, you've gained nothing.
And here's the key insight about spending. Every spending decision is really a long-term decision in disguise because it affects your baseline lifestyle. When you upgrade your apartment, you're not just making a decision about this month's rent. You're setting a new baseline that will persist for years. When you buy a luxury car, you're not just making a decision about transportation. You're committing to higher insurance, higher maintenance, and the psychological expectation of driving a luxury car. These baseline increases are very difficult to reverse. So before you upgrade any major aspect of your lifestyle, you need to be absolutely sure you can sustain it comfortably while still saving aggressively.
The second thing that matters is actually investing your savings rather than letting them sit in cash. Smart people often accumulate cash because it feels safe, and they haven't figured out their investment strategy yet. But inflation is destroying that cash. Even at 2 or 3% inflation, which is historically low, Money sitting in cash loses half its value over 25 years. You need to invest in assets that grow: stocks, real estate, a business. For most people, a diversified portfolio of low-cost index funds is the right answer. It's not exciting, but it works. And the earlier you start, the more powerful compound growth becomes. $10,000 invested at 25 grows to over 70,000 by 55 at a 7% return. The same 10,000 invested at 45 only grows to about 20,000. Time is more important than the amount you invest.
The third critical factor is avoiding catastrophic mistakes. Smart people often focus on maximizing returns when they should be focused on avoiding disasters. A single catastrophic mistake, investing your life savings in a friend's business that fails, getting divorced without a prenup, having inadequate insurance when disaster strikes, getting sued for something preventable, can wipe out decades of careful savings. This is why diversification matters, why insurance matters, why legal protections matter. These things feel like unnecessary expenses or excessive caution, but they're actually essential risk management. The person who avoids disasters and gets mediocre returns will end up wealthier than the person who has great returns interrupted by occasional catastrophes.
And the fourth thing, this one's probably most important, is giving it enough time. Wealth building is not a sprint. It's not even a marathon. It's more like farming. You plant seeds, you tend the crop, you wait for harvest. And there's no way to make it grow faster through cleverness or effort. A tree takes 20 years to mature, whether you're smart or not. Smart people hate this because they're used to being able to accelerate results through intelligence and hard work. But compound growth has its own timeline, and you can't rush it. This is why starting early is so important, and why staying consistent is so important. The person who invests for 40 years will almost always end up wealthier than the person who tries to make up for lost time with clever strategies or aggressive returns in their final 10 years.
Let me give you the brutal math on this. If you invest $500 a month from age 25 to 65 at a 7% return, you'll have about $1.2 million. If you wait until 35 to start and invest $1,000 a month, double the amount, you'll only have about $700,000. Those 10 years you waited cost you $500,000, even though you invested less money in total in the first scenario. That's the power of time, and no amount of intelligence can overcome the mathematics of compound growth. The smartest thing you can do is start now, even if you can only start with a little.
Now let's talk about what smart people should do differently. First, separate your professional intelligence from your financial decisions. Your intelligence is an asset in your career. Use it there. Negotiate aggressively for compensation. Develop valuable skills. Build a reputation. Create leverage in your work. But when it comes to investing, check your ego at the door. You're not going to outsmart the market. You're not the exception. Accept this, and you'll avoid the most expensive mistakes smart people make. Be smart about your career, humble about your investments.
Second, optimize for the big decisions and ignore the small ones. Where you live, who you marry, what career you choose, whether to have kids and how many, whether to start a business. These decisions will determine 90% of your financial outcomes. Which credit card you use, or whether you buy generic or brand name groceries, determines maybe 1%. I see smart people spending hours optimizing the 1% decisions while making the 90% decisions impulsively or without adequate thought. That's backwards. Spend your analytical energy on the decisions that actually matter.
Third, build systems instead of relying on willpower. Willpower is a finite resource, and you're going to have bad days, stressful periods, moments of weakness. If your financial success depends on making the right decision every single day, you'll fail. Instead, automate everything you can. Set up automatic transfers to your investment accounts. Set up automatic bill payments. Structure your life so that the default action is the correct action. The money gets invested before you see it in your checking account, so you're not tempted to spend it. This is how people who aren't particularly disciplined still manage to build wealth. They've automated the discipline.
Fourth, be extremely skeptical of anything that sounds too good to be true, especially if it appeals to your intelligence. This sophisticated strategy can generate 15% returns with minimal risk. This opportunity is only available to accredited investors who understand the complexity. Most people don't know about this tax loophole. When you hear pitches like this, your intelligence makes you vulnerable because you think, maybe I'm smart enough to understand something others don't. But usually, what's actually happening is someone is using your intelligence against you. They're making you feel special and clever right before they take your money.
Fifth, and this is hard for smart people, surround yourself with people who are better at money than you are and actually listen to them. Not people who talk a good game about money, but people who have actually built wealth through boring, consistent behavior. Find mentors who are where you want to be financially. Watch what they do, not what they say. Most wealthy people I know are shockingly frugal in their daily lives. They don't try to signal wealth. They drive older cars. They live in modest houses. They avoid flashy consumption. Meanwhile, the people who are trying to look wealthy are usually broke. Learn to tell the difference.
And sixth, develop what I call financial self awareness. You need to understand your own psychological weaknesses around money. Are you a status seeker who needs to keep up with peers? Are you someone who uses shopping as emotional comfort? Are you overconfident in your ability to pick investments? Are you paralyzed by fear of making mistakes? Whatever your weakness is, you need to know it and build guardrails around it. If you know you're tempted by lifestyle inflation, set strict rules about when you'll allow lifestyle upgrades. Maybe only when your net worth hits certain milestones. If you know you're tempted to trade too much, use a portfolio that you can't easily trade. Design your financial life around your weaknesses, not your ideal self.
Let me address something specific that comes up a lot. People ask me, when is it okay to start spending money and enjoying life? And this is a legitimate question. You don't want to save aggressively for 40 years and then die before you get to enjoy it. Here's my answer. You should be enjoying your life all along. But your enjoyment should come from things that don't cost a lot of money. Time with family and friends, engaging work, hobbies and learning, physical health and fitness, being part of a community. These are the things that actually make people happy, and they're either free or very cheap. The expensive lifestyle upgrades that smart people think will make them happy, the luxury car, the big house, the designer clothes, these provide very little actual happiness. The research on this is clear. Once you're above a basic threshold of material comfort, more spending doesn't correlate with more happiness.
So the answer is enjoy your life now, but do it cheaply. Find the things that actually bring you satisfaction and focus on those. And then, once you've built real wealth, once you have enough invested that you could live off the returns if you needed to, then you can start loosening up on spending if you want to. But even then, most people find they don't actually want to spend more. Once you've lived frugally for years and built wealth, the wealth itself becomes satisfying. You have security. You have options. You have freedom. Those things feel better than any luxury purchase. The people who are happiest are usually the ones who have plenty of money and choose not to spend it, not the ones who are spending money they don't have to impress people they don't like.
Here's something I want smart people to really understand. Building wealth is not about deprivation. It's about intentionality. It's about spending money on things that actually matter to you and not spending money on things that don't. I know people who spend $5,000 a year on travel and experiences they truly value, and they get enormous satisfaction from that spending. But they don't spend money on a fancy car because they don't care about cars. They've thought about what actually brings them joy, and they allocate their money accordingly. That's completely different from someone who just spends reflexively on whatever their peer group thinks is impressive. The first person is making conscious choices. The second person is being controlled by social pressure.
And here's the thing about intentional spending: it actually increases your satisfaction because you're not wasting money on things you don't care about. When you spend $200 on something you've deliberately chosen because it aligns with your values, that feels great. When you spend $200 on something you bought impulsively or because you felt you should have it, that feels empty. Smart people often experience this. They make good money, they spend a lot of it, but they don't feel satisfied. That's because their spending isn't intentional. They're consuming to signal status or to meet some imagined expectation, not because the things they're buying actually improve their lives.
Let's talk about one more trap that catches smart people: the sunk cost fallacy. You know what this is intellectually, the idea that you shouldn't let past investments dictate future decisions. But smart people violate this principle all the time with money. They'll stick with a financial advisor who's not serving them well because they've been with them for years. They'll hold on to an investment that's clearly a loser because selling it would mean admitting they made a mistake. They'll continue in a career they've grown to hate because they invested so much time and money getting the credentials. The smart move is to ignore sunk costs and make decisions based on the current situation and future prospects. But that requires admitting you made a mistake, and smart people really hate doing that.
This is especially true with education. Someone goes to law school, spends 3 years and $200,000, passes the bar, works as a lawyer for 2 years, and realizes they hate it. The smart financial decision at that point might be to switch careers, even though it means wasting the law degree. But they can't do it. They think, I invested all this money and time, I can't just throw it away. So they spend the next 30 years being miserable in a career they hate, which is actually throwing away way more. They're throwing away 30 years of their life. The law degree is a sunk cost. The question is, what will make you happy and financially successful going forward? Not, how do I justify the investments I've already made?
All right, let's bring this all together. If you're a smart person and you want to build wealth, here's the simple formula: live well below your means, not at or above them. Invest the difference in boring, diversified, low cost investments. Be patient and let compound growth work. Avoid catastrophic mistakes through diversification and insurance. Don't try to be clever with your investments. Focus your intelligence on your career, your skills, your business, things where intelligence actually provides an edge. And most importantly, start now. Not after you've figured out the perfect strategy. Not after you've read 5 more books. Not after your next raise. Now.
If I had to summarize everything we've talked about in one sentence, it would be this: smart people fail to build wealth because they optimize for looking successful rather than being secure. And they use their intelligence to rationalize expensive mistakes instead of implementing boring discipline. The path to wealth is simple, but simple is not the same as easy. It requires patience, which smart people lack. It requires humility, which smart people struggle with. It requires consistency, which is boring. But if you can develop those qualities, patience, humility, consistency, you'll build more wealth than 95% of people, regardless of your IQ.
And remember, the goal isn't to be the richest person in the cemetery. The goal is to have enough wealth that you have freedom. Freedom to work on projects you care about. Freedom to spend time with people you love. Freedom to take risks and pursue opportunities. Freedom from financial stress. That's what wealth actually provides. It's not about the car you drive or the house you live in. It's about having options. And the beautiful thing is, you don't need to be a genius to achieve this. You just need to avoid being stupid, which mostly means avoiding the stupid things that smart people do.
So, if there's one message we want to leave people with, it's this: your intelligence is an asset, but only if you use it wisely. Use it to build valuable skills, to negotiate better compensation, to create products or services people want, to solve problems in your career. But when it comes to investing and wealth building, you're almost better off being average intelligence with excellent discipline than being brilliant with poor discipline. The plumber who saves and invests consistently will beat the doctor who spends everything, every time. That's not a maybe, that's mathematics. And if you're smart enough to understand this conversation, you're smart enough to build wealth. You just have to actually do it.
One last thing I'll mention, and this is perhaps the most important point of all, is that time is the most precious resource you have, not money. When you're young, you have the most valuable asset in the world, decades of compound growth ahead of you. But most smart people squander this by spending the first 10 years of their career focused entirely on income and status without saving anything. Then they wake up at 35 and realize they need to start saving, and they've lost 10 years of compound growth. Those are the most valuable years because money invested at 25 has 4 decades to grow. Money invested at 35 has 3 decades. That 1 decade makes an enormous difference. We're talking about hundreds of thousands or millions of dollars over a lifetime. So if you're young and you're listening to this, understand that the most important financial decision you can make is to start saving and investing now, even if it's a small amount. Time is your greatest advantage. Don't waste it.
And if you're older and you're thinking, well, I've already wasted those years, so what's the point? Let me tell you, the second best time to start is now. Yes, you would have been better off starting at 25, but you'll be even worse off if you wait until you're 50. The same principles apply regardless of your age. Spend less than you earn. Invest the difference in sensible assets. Be patient. Avoid stupid mistakes. It's harder if you're starting late because you have less time for compound growth to work. You might need to save more aggressively. You might need to work longer before you can retire. But the path is still the same. And the alternative, continuing to spend everything you earn and hoping something will magically change, that doesn't work at any age.
So that's our message to smart people who want to build wealth but haven't figured it out yet. Stop trying to be clever. Start being disciplined. Stop optimizing the details. Start getting the big decisions right. Stop comparing yourself to your peers. Start focusing on your own goals and values. Stop thinking more income will solve your problems. Start recognizing that discipline, not income, is what builds wealth. It's simple advice, but if you actually follow it, you'll be wealthier than almost everyone you know within 20 or 30 years. Not because you're smarter, but because you avoided being stupid. And that's the secret that the plumber understood and the doctor didn't. Before we close, I need to make something clear to everyone listening. This entire conversation is AI-generated content. These are not the real voices of Warren Buffett or Charlie Munger. We're using their names and investment philosophies as an educational framework to discuss rational wealth-building principles. But this content does not represent them personally, nor are they involved in any way with this channel. This conversation is purely for educational and entertainment purposes. Nothing we've discussed should be taken as personalized financial advice. Everyone's financial situation is unique, and you should always do your own research and consult with qualified financial professionals before making any investment decisions. If you found this valuable and want more content like this, exploring timeless investing wisdom and rational thinking, please subscribe to the channel. Thank you for listening, and we'll see you on the next one.